Hello, welcome back to the AJ Bell Money and Markets podcast. I'm Dan Coatsworth, and with me this week is Danni Hewson. Hi there, Danni.
Hi, Dan. Hi, everyone. Can you believe that we're 3 weeks out from the budget? And unusually, we've already heard from the Chancellor.
Yeah, rolling the pitch, setting the scene, whatever you want to call it. It does feel like Rachel Reeves has laid the foundations for tax hikes. So we're going to take a look what that might mean for your pocket if it happens, and also how markets reacted to this sort of fairly unusual speech that we had pre-budget.
Yes, and how much sparkle did Marks and Spencer's lose from that cyber attack? We're going to dig through its results. And could high street rival Primark be spun out from its parent company?
Now, we're going to dig into why companies do occasionally split into different parts and also consider why that move can actually backfire. We've also got the timely news that Tylenol maker Kenvue is going to be bought by Kimberly Clark just a couple of years after being spun out of Johnson & Johnson.
Plus, the man who was immortalised by Christian Bale in the Hollywood film The Big Short bets on an AI bubble burst. And with a different slant on big tech, not AI this time, but robotics. Dan's been chatting to Simon Edelsten, manager of the Goshawk Global Fund, about automation and why it's hot news again.
So, another quiet week then, Danni.
I know, we seem to say this every week at the moment, and every week something seems to land a bit like a great big splat of ketchup. And wow, that's certainly what it felt like when we got the news that Rachel Reeves was going to stand up in Downing Street and make a speech just over 3 weeks out from the budget. Now, I can't even begin to sort of put into words how unusual this is, because normally in the weeks leading up to the budget, there's putting people out all the time to fend off all the rumours and speculation, to say, well, you'll have to wait and see what the Chancellor says when they get to the budget. I mean, can you remember a moment, Dan, when the Chancellor came out?
So no, I've never seen anything like this before. I think the fact that we suddenly had this sort of news, she's coming to do a speech, it was very precisely 8:10. It sort of implied this was like some emergency announcement. Danni, what on earth did she actually say?
Not much. There was not an awful lot in that speech, but she actually spoke volumes in that speech. I think what's really important to note here is it wasn't aimed at you and I. It wasn't aimed at the money markets. It wasn't aimed at people that listen to this podcast and have a real sort of finger on the pulse on what's going on in terms of the nation's finances in general. This was aimed at the people who are sat at the breakfast table. Maybe they've got BBC Breakfast News on and they are not aware that over the last few weeks, the normal amount of pitch rolling has been going on in all the newspapers, where the Treasury drops these great big hints or slips bits of information to the papers to say, basically, look, things are bad. We've had this downgrade in productivity from the Office for Budget Responsibility, the OBR. We were talking about that last week with Tom. So that's another sort of chunk to add to this black hole that Rachel Reeves is looking to fill. And we're now really, from what she didn't say, expecting that she will go back on her manifesto pledge, the government's manifesto pledge, not to raise income tax, VAT, or national insurance on, really importantly, working people. And I've been fascinated to discover that I am not a working person, Dan. You are not a working person, because a working person, according to the government, is someone that is earning £45,000 or less. So 2/3 of income earners. And you can read into that what you will, because they've been talking about protecting working people. And yet you also have the Chancellor saying that everyone needs to do their bit. So does that suggest that everyone is going to be hit by an income tax increase, or does it suggest that only higher earners might be impacted by an income tax increase? We do know a couple of things from what she said. First of all, she's committed to her fiscal rules. She said that again. She said that she wants to bring down debt. And it was really interesting how she referred to that, because she was saying, look, 10 pence in every pound that the government spends is not going on paying down the debt. It's going on paying the debt interest. So that needs to change. She wants to bring down inflation, and she doesn't want to return to austerity. So wrap that up in a nice breakfast time shaped bow, or a waffle bomb, as it has been referred to by the leader of the opposition. And it was fascinating. But as I say, it wasn't aimed at markets, which is probably why markets didn't react that much.
Yeah, there was some movement, but it wasn't sort of headline grabbing stuff. So the first thing we want to do whenever the Chancellor starts to talk about the outlook for the economy and stuff, you want to look at the bond market. So gilts, that's UK government bonds. So the 10-year gilt yield fell as Rachel Reeves began her speech. So that kind of indicates that bond investors thought, okay, here we go. We're going to get confirmations that tax is going to go out of the budget. So if gilt yields fall, it means the prices are going up. People want to buy them. So the idea that if we have higher taxes, it essentially could help to repair the public finances. So bond investors would take that as a positive. As the speech went on and it became clear that Rachel Reeves was kind of just dancing around the topic, not actually giving a firm answer, those yields on the 10-year gilt went back up again. But by the end of the day, they were down just slightly. So fundamentally, at the end of the day, Rachel Reeves' speech had slightly reduced the cost of borrowing for the government. The pound was interesting. That hit the lowest point since April. I guess you could view that as prospects for potentially a weaker economy near term. So if Rachel Reeves is kind of laying the foundations for some more bad news at the budget, does that suggest a weaker economy near term? And you look at the stock market, the FTSE 100 was down, but I'd say that was partially to do with mining stocks. They're not really anything to do with the UK economy. That's a global play, or if anything, play on what's going on with construction in places like Asia. So overall, you're right, Danny. It wasn't a massive market movement thing, but it was interesting. It gave little hints at what we could see once we get the actual budget day. I think there's lots of businesses and consumers are sort of looking to this, event at the end of November. They're quite worried about what we could get. So we'll do a special on the podcast when we get all the information for the budget. We'll let you know, and we're also going to have a bit of a webinar event as well to do some Q&A. But we can talk to you about that nearer the time.
What was interesting though was the movement in the pound. Because it's been falling against the dollar, and it fell again against the dollar, and it's fallen again today against the dollar. And a lot of that is down to the fact that there is now speculation. Now, markets aren't pricing in an interest rate cut by the Bank of England. And because of the magic of podcasts, by the time you listen to this podcast, you'll know what the Bank of England did. But just looking at where the pound is going, it suggests there's a little bit of sort of uncertainty about what the Bank of England might do this time out, or at least certainly what they may signal in terms of how they vote. But we wanted to go through some of the potential tax implications from what Rachel Reeves said, because there are a number of things that could change. And I know you're going to go through the numbers in a sec of how it's going to impact potentially people's pockets. But just a couple of the things which are very much in the frame at the moment. Lots of speculation that the non-tax tax, that stealth tax, the freezing of thresholds that she said in the last budget, and there was a great big gasp and, oh my goodness, she's actually going to unfreeze these tax thresholds. No, that's likely to be frozen again longer than 2028. We also have a lot of discussion about a 1 pence increase on the basic rate of income tax, maybe 2 pence. So it depends on which think tank you are looking to or reading about as to what size they think the black hole is and exactly how much taxes need to go up by. And there is also another option, which could be to increase income tax by 2 pence, but then cut national insurance by 2 pence, effectively balancing it out for people that are earning a wage, but still raking in money from people like landlords and also people who are taking a pension income, or certainly of pension age. The one thing that we did sort of seemed to get a firm no on from what Rachel Reeves said was an increase in VAT, because she made it clear that she didn't want to increase or see inflation go up again. But there are a lot of variables, Dan.
Yeah, absolutely. So, I mean, I think I want to just focus on income tax. So I think that if we were to see some changes on that, there's going to be, it's natural that people have lots of questions like, what would it mean? So we've done some sums about what would it mean if you add 1p to the basic rate of tax. So that would increase it from 20% to 21%. It would cost taxpayers up to £377 a year in extra tax, with anyone earning £50,270 or more facing the maximum hit. So I think if the government decided to increase the higher and the additional rates of tax, that raises far less money than just simply changing the basic rate. So based on HMRC figures, increasing the basic rate to 21% would raise 6.9 billion in the next tax year and 23.4 billion over the next 3 years. If you hiked the higher rate to 41%, that would raise 1.6 billion next year. Increasing the additional rate to 46% would raise just 145 million pounds in extra tax revenue. So I think it's natural that there'll be lots of people reaching for their pens and papers as soon as we get this budget and going, right, I need to start fresh, I need to exactly understand what this means for me. And we will go through all the numbers and all the key calculations on a future podcast, so give you the answers that you need.
It is so complicated, Dan, and I've seen quite a lot of coverage when we're discussing all of this with people saying, why does tax have to be so complicated? Wouldn't it make more sense, and this argument's been around for a while, to get rid of national insurance and just have income tax? And as you're absolutely right, we will take a look at this, because I think when we get the sums, there's going to be an awful lot of digging into those sort of bits of small print to try and figure out what is going on. Right, we're going to move on. We're going to talk about some markets news, and a bit of markets news that people have been waiting for ever since Marks and Spencer said that they'd been hit by that cyber attack. And, the shops, their shelves were empty in the shops, and online orders, you couldn't place them. And Marks and Spencer said, look, we expect that this is going to cost us around £300 million this financial year. So we finally got the update from Marks and Spencer's looking at this period. And Stuart Machin said, look, in May, we anticipated that the material impact of the incident on group operating profit would be around £300 million this financial year, and we are broadly in line with that. What was interesting was to note that shares in Marks and Spencer's, they actually rose off the back of these results. Not a massive amount, but a little bit. And that, I think, is because, first of all, it said that it's received £100 million of insurance money related to combating the cyber attack. I should just say that when we're talking about that statutory profit, so that's a figure that reflects all costs for the period, it slumped 99% from 391.9 million to 3.4 million for the first half of the year, compared with the year prior. So that's completely wiping out the profit. But one of the things that I saw was just incredible. Food sales over that period of time were actually up 7.8%, despite the fact that it was an horrendous period of time. You couldn't get a lot of stuff on the shelves. I know certainly that trying to do the orders without the computer systems in place, they were just having to say to the businesses that they worked with, whatever you sent last week, send again this week, and we'll deal with it afterwards. We just need to have stuff on the shelves. And Marks and Spencer's food business has just really gone from strength to strength. And have you been into the food hall recently?
Yeah. I mean, sort of trying to count the variations of products involving Percy Pig. It's like it's in the hundreds, isn't it? It's like
But they go viral. Percy pigs go viral right around the world. And I know certainly the international market is one of the areas where they're sort of beating their head against a brick wall a little bit. They're trying to sort of climb over that wall. They haven't quite scaled it, but they are determined. But yeah, food sales up 7.8%. They've brought in a lot of new stuff. And certainly they're expecting that Christmas is going to be another bumper year for them. Now, the other bit of the business, the main part, homewares and fashion, that declined, but only by 16%. Now, when you consider the fact that you had this period of time where actually it was really sunny and people were maybe spending at a time when they wouldn't have done normally, they wanted to buy new outfits and stuff. They weren't going to M&S. They were possibly going somewhere like Next, which does give me a bit of a niggle because, once they've gone there, are they going to come back? So Marks and Sparks is going to have to work hard to get those people back, but it's proved that it can do that. And I think that really is sort of the reason why that we have seen shares rise today.
Yeah, and I thought I sort of read it and thinking, given what they went through, I think we all remember the headlines over the summer, like about the disruption to the shelves and disruption to orders, and it went on and on and on. It could have been a lot worse, couldn't it? I mean, it was, the headline profit figures alarming, but it's like the stock market is about what will happen next. And I think people seem to be sort of taking the view that, food is always really good. Clothing is a bit slow to catch up, but it seems to be some positive noises from the company. Overall, it seems to be pretty good. And you get that, even if we have a gloomy sort of period with the budget, I feel that people do like, if they're going to treat themselves, Christmas is probably one time. And I think a lot of people say, okay, I'm going to have a little treat. And inevitably that might mean some nice food. And M&S is the place to go, isn't it? I know. I'm sort of talking to colleagues at Danni. You've already done your Christmas order then for?
Yes, I have. Yeah, I was straight out the gates because if you want to get that slot on the 24th of December and you want to be there really early in the morning before anyone else turns up, so the car park is fairly okay, then yeah, you've got to get in quickly. And I think I was possibly one of the first people out the gates. Other retailers are available.
Yeah, I mean, it was really interesting, but it was also, we've also had another set of company results, which is one I want to talk about now. That's Associated British Foods. And I guess most people know this as the parent company for the high street favourite, Primark. For years, people have been saying, I quite fancy investing in Primark, but I don't really want to invest in a parent company which also owns interests in food and ingredients and sugar, and it's all a bit confusing. I'd rather just simply have shares in Primark. The company's already sort of batted that away and saying, no, not so sure. We want to split. We like the idea that if one part doesn't do as well, everything else is there as a cushion. So we've had the results come out, and the entire business saw profits down 13% to £1.7 billion for the year to September. The sugar arm was weak. Grocery arm was mixed. Ingredients was pretty good. Retail, I'd say mixed. It's not been as good as it has been in the past, but you can see it's got those different components together. Historically, it's helped to sort of deliver an overall sort of resilience. But now, I sort of noticed that the share price has sort of been quite volatile the last couple of years, not really going anywhere. And they seem to have come out and sort of had a real change of tact. The board has sort of said, maybe we should think about this. Maybe we should. There's value in splitting the company into two. So you'd have one just the food sort of stuff, and the other Primark. Danni, were you surprised because it was the hot topic in the office when everyone was coming in just after those results coming out?
I was surprised, but the one thing which has really pricked my ears up about Primark over the last couple of months is how well the US business is doing. And that is, of course, because you've had that de minimis loophole curtailed. It's gone. It's been tightened up, which means that those Chinese retailers like Shein and Temu, which are those value clothing ranges, they've become more expensive in the United States. So actually going to a physical store, Primark, which is, expanding over in the States suddenly becomes quite appealing to a US audience. And suddenly, the argument for growth within Primark takes another twist. So after the first sort of, oh, well, they've not said that before, that's interesting, I was like, aha, well, it makes sense.
Yeah, I mean, if you look at the results of Primark, had a pretty miserable first half of the year, down 4% like sales, picking up in the second half, but it's only a small improvement, plus 1%. But I think it's fair to say it is a tough market out there, particularly in the UK, where you do see really fierce competition from the likes of Shein and stuff. I do quite like to pop into Primark stores. I find that the shops are pretty smart. Particularly if you go if you go on a Saturday morning, then they're nice, everything's there. If you go to the Saturday evening, it's absolute chaos because everyone's pulled all the clothes everywhere. But I feel like they do a good job. And I think that you can see why there is a certain type of investor who might be really interested if the company does decide to split. I must stress that the board are saying it's an option to be reviewed, not a firm thing, but. And I think it is. I think it's a good one. We have seen this before with lots of companies, and it's definitely a sort of a live trend as well. So I thought I'd go and have a quick reminder of who's split. Just looking at the UK market to start with. Danni, do you remember a company called Gus? Gus. This is going back a bit.
No.
Going back about 20 years, it split into two. It was on the stock market. One half became Experian, the credit agency. The other half became Home Retail, which is Argos and Homebase. Since then, Sainsbury's bought Argos. Now it wants to sell it again. Some other ones that you might know are Anglo American, the mining company. That actually spun off Mondi, which is now a gigantic packaging company, and it's done a few sort of smaller mining things over the years. Whitbread spun off Costa Coffee. In the States, we've had Kellogg's split into a couple of things, and we've got Kraft Heinz now. He's in the process of splitting into two. I knew it was splitting, but I went and just before the podcast to look at what the new company names are going to be. So, Danni, this is putting you on the spot. Have you seen the proposed names of the two separate parts of Kraft Heinz?
Yes, but I can't now remember. Now you've put me on the spot.
One is going to look after brands like Heinz Philadelphia, and so Kraft Mac and Cheese. It's going to be called Global Taste Elevation Company.
That's a mouthful.
I think, in this age of trying to get rid of jargon and sort of marketing speak and have something that the everyday person can understand, that is just utter nonsense, isn't it? Global Taste Elevation Company. The other half is going to be called North American Grocery Company, and that will do things like Kraft singles, Lunchables and stuff. So grocery staples. It's a weird one because obviously Kraft and Heinz are two companies bolted together. Now they're splitting apart. What do you? I think you've looked at Kraft. What do you think about that one? Does that make sense? Splitting that one?
Yes, I think it possibly does. Just because the market is moving on, and separating out what is a very old-fashioned business and maybe being able to sort of try and push it in a different way. Potentially it does make sense, but I don't now feel bad that I'd forgotten the names of both of those because they don't exactly trip off the tongue, do they? I thought when GSK was spinning off Haleon, I thought, well, that's a weird name, but at least it was one word.
Yeah, exactly. Yeah. So, you have to sort of ask, what does this really mean? If you hold shares in one of these companies and they decide to split into two or even three, we've seen over the years, it means that you theoretically you should get shares in the companies being spun off, and the value of the shares in the original parent company should sort of fall in line to adjust for essentially a big chunk of it being taken away. Investors quite often like this situation because you've got essentially a component part of a business that's suddenly freed of its big parent company, and you get management to go, wow, we can actually make decisions ourselves without having to report to the big parent. We can do things faster. We don't have to do everything it's got to follow sort of the complete parent culture and stuff. We can do things our own way. But it doesn't necessarily mean that these things will work. So we've had Kenvue. We mentioned at the start. Kenvue was separated from Johnson & Johnson. Now it's been taken over. This isn't necessarily a good thing. Danni, what's going on there with Kenvue?
Yeah, I think it's caught a lot of people on the hop, actually. I mean, there had been sort of speculation that Kenvue, which has had a significant amount of issues over the last couple of years or so, not least because it became the target of Donald Trump and the White House. Donald Trump, a couple of weeks ago, said, hang on a second, Tylenol, which is one of Kenvue's brands, said, if you're a pregnant woman, don't take Tylenol because it can cause autism in children. Now, those are unproven claims, but there are a number of lawsuits linking its painkiller to autism. So any potential litigation, of course, will follow this company to wherever its new home is. And that's really hard to quantify how that potentially could cost its new owner. And its new owner is Kimberly Clark. And this is a huge deal. I mean, you are talking about, more than 40 billion, 48.7 billion, the cash and stock deal. And I don't think anyone was also surprised that Kimberly Clark shares were down 15% in pre-market trading, and Kenvue stock went 22% up. Because if you've got a much bigger company, obviously there's a lot more in terms of cushioning for any potential litigation costs down the track. Now, if you look at it on paper, if you sort of take away any concerns about this potential litigation, then it kind of makes sense, because a lot of the products that Kimberly Clark that Kenvue makes, sit side by side to each other on the shelves. So, you've got a whole load of brands here, Neutrogena, Band-Aid, Listerine, Huggies. This is potentially somewhere that Kimberly Clark can make use of its new size. It can look to cut costs. It can look to share distribution. And it does make sense. But this big question really does hang over the business, which of course is why a lot of investors are sort of shaking their heads about why this decision has been made. But it also just shows that Kenvue was part of Johnson & Johnson. It was spun out of Johnson & Johnson. It's not been out of the hands of its parent company for very long. And now it's looking to get back under the umbrella of another parent company. It just goes to show that sometimes these spin-offs don't always work.
Yeah, I mean, it's probably just worth touching on one final point, is that if you think that if you're an investor and you've chosen the parent company, and then it splits and essentially you're getting free shares in a small part of it, sometimes you don't always want that small part. I think a really good example is when Travis Perkins split and spun out Wix, the DIY retailer. I think for quite a long time, people going, it's fairly small. I bought Travis Perkins because it was really big with tradesmen, but I don't really want a sort of a consumer facing business. And it's only through sheer determination and proving to the market that actually Wix as a standalone business was able to do fine without its parent company. It took ages to win over the market. So, like you say, it can be good, but it's not always guaranteed to be good when things split. Should we talk AI? I figure we thought we'd have a break from it this week, but we can't.
We need a klaxon. I think I always wanted an Elon Musk klaxon, but I now think that maybe just an AI klaxon. AI must be able to come up with some kind of sound effect that we can use.
Yeah, I mean, I remember when we started this podcast, we had a klaxon every time we talked about Brexit. So maybe we could just find whatever we used in the office for that. So, I mean, we have talked about AI, and it is I feel like it is really important to keep abreast of what's going on. The reason why I want to talk about it this week is that Michael Burry, the trader who inspired the film The Big Short, has basically come in and taken some bets against a couple of really big companies. So one is Nvidia, the chip company. The other one is Palantir, the data company. So Michael Burry, people know him from this film, The Big Short. It was all about traders who made millions from predicting the collapse of the US housing bubble in 2008. So people watch what he does. He's fairly low profile since that film, but occasionally he pops up, and he's popped up this week and sort of said his company has bought some financial products that essentially he will profit if Nvidia and Palantir shares fall. Now, he's making some cryptic messages on social media about bubbles, and this is kind of playing to stuff we've been discussing in recent weeks. Some investors, not all, some are worried about really high valuations for some of these big AI tech stocks. There's other things going on as well. Worries about US regional banking sector, lots of sort of incestuous behavior amongst these big tech companies in America all seem to be investing each other and they're each other's customers, and some liquidity issues in America as well. So when you get various leading figures in the financial world, like some of the big bankers, saying, oh, I think the markets are looking maybe a bit toppy, then you get this well-known trader coming along saying, I'm going to bet that some of these are coming along. It's no wonder you're getting a bit of a wobble on the financial market. So we had on Tuesday, pretty miserable day on Wall Street. All the big tech companies were going through some tough times. And it sort of raises a question once again, are we at the market top? The answer is no one knows. Is there a bubble? We don't know. And we've discussed the reasons why there might be and also why there might not be in recent weeks. So if you've not listened to the podcast for a couple of weeks, go back, listen to them. We talked to some brilliant people and debated about all of this stuff. So no one knows what's going to happen next, but just be aware that whilst you might see headlines saying stock market's another record high, there's also lots of reasons why people are going, have we had such a good year? It can't always be like this.
We've had some absolutely fantastic guests on the subject over the past couple of weeks. We do always try to bring you guests to talk about things which are really relevant in the news. And this week, we've actually gone for something a bit different because we haven't spoken a lot about robotics this year. And it is a fascinating space. And that is what our guest interview this week is talking all about. Dan, I know you caught up with Simon Edelsten, who is manager of the Goshawk Global Fund, to talk about why factory automation is hot news again and why Nvidia is going big on robotics. Let's hear what Simon had to say.
It does feel like everyone was talking about robotics, I don't know, 10 years ago, or certainly 2016, 2017, it was hot. Why is it sort of become topical again? Is this to do with advancements in technology, and essentially robotics can do a lot more now than they could a decade ago?
Morning, Dan. Thank you very much for having me. You're absolutely right. Robotics is not a new thing. So anyone who's kept an eye on the car industry, for instance, will know that a lot of robots replaced an awful lot of people making cars many years ago, and we now end up with cars which, frankly, are a lot more reliable than they were when they were made by us. So these transitions do go through a period where blue collar workers, the numbers of them reduce because you don't need so many to do the work. Often the robots are only brought in when the robots are more efficient than the workers. So it is the hard-nosed end of capitalism, if you like. But the other thing that comes out the other end is that you end up with better products, more profits, and the people who carry on working in the factories and operate the robots are better paid than the people who were there bashing metal many years ago. So these are transitions based on technology. The second point you made, though, yes, there are waves of robotics. And I think what we're looking at now is a new wave of robotics where the old robots basically used to swing large amounts of metal around and you didn't want to go anywhere near them. And you turn them on and they did a very good job of doing that. So they help make cars and ships and that sort of thing. The new wave even before AI came along, was about robots doing much cleverer things, much more gentle things, if you like, and being able to handle things that robots couldn't handle in the past. So there are whole industries where there are almost no robots used, where we think that they'll end up being a lot of robots used. Things like making clothes. You know, a lot of sewing and stitching is still done in less developed parts of the country by large numbers of people in what really aren't much better than sweatshops. And then other things like handling food. Food manufacturing, food distribution. Robots have now got to the point. Japan had a prize running for years for a robot that could peel a boiled egg, and it's finally been won. So that's a combination of robot, but also very good sensors and very good motors.
Yeah, I mean, I think people think about AI, and the first thing that springs to mind is like, yeah, it's potentially it's a more sophisticated way of searching for information, summarizing data, but also I guess it's being used for the brains for robots, particularly to train them, and also so they can work harder, faster, smarter. I noticed that Nvidia is sort of the big AI chip giant is actually pushing hard on robotics. I did see some suggestion that was perhaps in recognition that data center chips is now pretty big market, but also highly competitive. So are they looking? They're looking for the next thing down the line. So they obviously think that robotics is a good place. Obviously, if you as an investor, how do you go about sort of picking sort of the winners from losers in robotics space if you've got someone like Nvidia now sort of muscling in on the area?
You're absolutely right. So yeah, Jason Huang emphasized robotics and his aims in robotics, his ambitions. But he is talking about supplying specialist chips for that sector as it grows out in 28, 29, 30. And because his business is already so big on the data centers, where they're having their boom at the moment, you would expect him to come up with some bright ideas for growth down the track. But unfortunately, it also probably reflects the fact that he knows that the goings have been pretty good in what he's doing, and there could be a bit of a transition period between one and the other. So he sold a lot of these training chips, very expensive. We're seeing all these announcements at the moment. There could be a bit of a lull for a while, and then maybe get the robotics chips. Whereas for the robot companies we're investing in, such as the Japanese ones, these shares have been going down the last few years. They had been selling a lot of robots and the sensors for robots to China. China's had a bit of a slump. And so the valuations on these stocks are much, much lower than the highlighted AI stocks, the famous ones in America. But we think we'll probably get more of a benefit across more of their business. And I think that this is the whole point about AI, that the excitement is about the training phase at the moment. But the real world story here is about which businesses are going to benefit in terms of productivity improvement later on. And they're the shares which haven't really moved on this at all. I mean, one does have to be patient, but the point of AI and the greater computing power, greater machine learning you're getting here, whichever bit of it you think is really going to work and be paid for, those benefits will be spread across a very large number of stocks, not just the small number of very large American shares which have led the market up.
You mentioned about some names in Japan. I mean, Keyence. I'm terrible at pronouncing these companies, but they've been a big player, but their shares have been pretty weak recently. I'm just wondering if you think it's partially because demand's slightly weaker from China. Is there not a threat that actually China could develop its own sort of robotics stuff? It doesn't actually need to use sort of these big names from Japan, because clearly they're doing it on other areas of AI, like with the DeepSeek, for example.
Yeah, absolutely right. So in our portfolios at Goshawk, we've always had Japanese robot stocks. One of the amazing things about robot making itself is the Japanese lead the world in this. There are a couple of companies in Europe, one of which has just been bought by a Japanese company, funnily enough, a few weeks ago. The Americans are miles behind on it. I mean, there aren't many areas where you could say America really hasn't got going on something which has been in the news since I was a child watching Forbidden Planet. I mean, this is not new news. Um, so so it's a strange area where Japan leads the world. The Chinese are determined. It's a state-sponsored enterprise by Beijing to make their own robots. And I've seen some Chinese analyst notes saying that a company called Innovance, which trades on a very, very large rating indeed, is going to be eating the bulk of the market against the Japanese makers. And then I look at the share of which robots the Chinese are making, buying themselves for their plants, and oddly enough, they're still buying a lot of Japanese robots because they're much better. I mean, I think the point here, and the company we have, which the two companies we have, Keyence is the world leader in making sensors for robots. So that's the clever bit, and nobody's really managed to catch them up for years. The shares are quite expensive as Japanese companies go, and so they haven't had that much growth, so they haven't performed all that well. But they're still likely to grow very, very well through this boom. They're absolute core holding in terms of nobody being able to catch them up. There's one American company sort of close, but that's it. In terms of Yaskawa, which is the leading market in the robots you have inside semiconductor plants. I mean, if you're spending $3 billion, $4 billion, $5 billion on a plant, even if it's in China, you don't want to cut price robot in the middle of it in your secure room handling the chips. And so and the second thing they do is they make the best servo motors, which are the motors which make the robot arms stop and start accurately. And again, if you're trying to peel boiled eggs, you need really, really accurate servo motors. You can't have ones which are cheap but not quite as good. So absolutely, you've got to keep an eye on the competition. In fact, we believe long term Chinese companies will end up producing some of the best products in the world. I remember in the 1980s, people said, "Oh, the Japanese, they just copy things. They'll never catch up the Americans." Well, I think we've seen now, you copy for a while, then you innovate, and then you manufacture efficiently. So you absolutely, one keeps an eye on it. We actually, where we do invest in China, it's in the AI stocks themselves. Alibaba and Baidu are both quite big holdings in our fund because we think they're producing good applications at reasonable prices for the world.
So, man, I guess the final question is, where next for robotics automation? Is it more intelligent robots going around everywhere that you see, or is it actually, the sort of the tomorrow's world image that comes to the mind is still years down the line, in terms of sort of all tasks being done by robots where possible?
Yeah, I think that there's a huge number of things robots will never be good at, and I think there's a huge number of things that humans will always be better at than AI. I mean, the people who pump up the enthusiasm about AI by talking about super intelligence and all that. I mean, they're using words we use about the brain, but the computers are not the same as the brain. Brains work in a different way. So they try to make. I mean, we are living through a period where there's massive amounts of more computing power. And I remember looking at the first pocket calculator and thinking, goodness, that can do long multiplication much more quickly than me. But I knew that it couldn't do other things, and it's still not done other things. So, there'll be things that big computing power will do. Mainly, it raises productivity, which is what we need in an economy. But there'll always be other things that it can't. But whether it's robotics or whether it's other applications of AI. Like improving our ability to do coding, improving the ability of non-coders to do things on the web in the way in which Windows allowed people to do spreadsheets and word processing years ago without having to learn coding. So there are lots of benefits going to come from this. But as I say, they're broadly spread across the index. Yeah. I don't think that they're just focused on a small number of rather expensive companies. So there are good reason to be enthusiastic about owning equities, but not a good reason, I think, to allow your savings to be too trapped in a small number of very high profile companies making trillion-dollar bets on just one way of looking at this problem.
Simon Edelsten from Goshawk Global Fund there. Now, before we finish up for this week, I just wanted to mention something which my ears pricked up this morning when I heard about government plans to shake up education. And one of the things that they are talking about doing is providing kids with some education on finance. So this is things, really basic things, which we have said for years really should be taught in classrooms. Things like what a mortgage is, how it works, how interest works. Those really basic, sound lessons, life lessons that can be really useful to children. Now, this is all part of the government's big plan to try and modernize the national curriculum. One of the things children will be taught about is how to do a budget, how to look at what's coming in and what's going out. I'm hoping there might be something in there, Dan, about investing and how you can actually, take a look at your budget and see you've got 20 quid at the end of every month. And what can you do with that? You can go and blow it at Starbucks on a couple of coffees, or you can invest it and then, see how that grows over time. I'm not sure quite there yet. But this actually is a good move. I mean, I know that quite a lot of the time we're taking a pop at what the government is doing, but in this case, it does seem that this review makes a lot of sense.
I love it. It's like you say, it's about time. And, let's hope this is the snowball that rolls and rolls and rolls, gets bigger and bigger and bigger. And there's much more. Danni and I are both parents. We know what it's like to try and explain to children about money and the importance of it, particularly when they're teenagers. They can, and actually, particularly talking about my kids, when I talk to them about money, they're very receptive. They want to know, they want to understand. And I think that's, if we can get more of that in the school, it will help people later on. It's so important. If you think about everything, your lives revolve around financial decisions and financial actions. I don't know why this has been sort of really sort of ignored for so long. And so many people, it's not just us, so many people have been calling for better financial education. Let's see it actually happen. So, Danni, I think that's it for this week. Don't forget to like and subscribe wherever you listen or watch the podcast. Next week, we'll be talking about investing in India and whether Donald Trump's tariffs regime has changed the situation there. So thank you very much, and we will catch you next time.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.